So just to share with the group, where CCS have actually changed their contract for webinars, so we are on a new product here, GoToWebinar. So hopefully it's all working okay for everybody. If you can't hear me, and you can just see my lips moving at this point in time, try and change your settings to change your speakers, and we think it's in the audio menu, but we are all still learning as we go along here. Also, if you've got any questions during the meeting, there's a questions box. I think there's a chat and a questions box. So if possible, put them in the questions bit. If you put them in chat by mistake, don't worry, we'll be monitoring that as well. And then we'll cover all the questions at the end of our session. Okay, Sam, do you want to just move on? Okay, so welcome to the CCS Energy webinar. So my name is Kate Beckingham. I am the Head of Energy at Crown Commercial Service. I'm joined today by my colleague Tom Gray, who's one of our senior power and gas traders from our trading and risk team at CCS. So it's been a busy 6 months since myself and Tom joined forces to provide a market update in September. And today's session is to update you all with what has happened and how it has affected the energy markets. Our session today is aimed at building on everything we've shared over the last year and to give support in navigating what is likely to continue in the coming months and years. The focus of this webinar will be electricity and gas. We will be talking through a bit of background to the market, how we transact, the current market positions, the drivers, how this impacts each of our baskets, and how the non-traded element of your prices is also driving costs. I will outline steps you can take to mitigate these increases and what CCS are doing to help public sector navigate through this current situation. We will host our Q&A session, as I said earlier, at the end of the webinar. So if you can add any questions you have during our talk on the question box, and we will cover as many as we can, including any that have been asked prior to the session. To remind everyone, this session is being recorded and contains information that is commercially sensitive and should be managed appropriately. And now I will hand over to Tom to talk us through the markets.
Classic, I forgot to unmute myself. Thanks, Kate. So yeah, just by way of introduction, so as Kate said, I'm Tom Gray, and I'm one of the power and gas traders at CCS, but my particular focus is on electricity markets. So over the next sort of few slides, we're going to go look at what's happened in the markets recently and how it's impacted prices. So as you can see from this slide, what we've tried to outline is that there's many different things that can influence the price of gas and electricity, and some of those examples are shown on the slide, which include weather, geopolitics, which is obviously quite important at the moment, wider commodities such as oil, coal and carbon. A trading team as part of a public buying organisation should be monitoring all of these different factors and influences, as well as some seemingly pretty random things such as rainfall in South America, to give them the best information with which to make decisions by which to hedge volume in the market on the customer behalf. There's numerous specialist services, systems and reports which are used to help inform these decisions, including live trading screens, which allow a trading team to make instantaneous decisions. Systems like Bloomberg and Reuters, which you may have heard of, can help with providing access to supporting data as well as analytical tools as well. Energy markets are highly complex, very, very interlinked across the globe, and knock-on effects of any event could have a very dramatic impact on gas and electricity prices across the world. And at CCS, we've got all of this covered. Next slide, please, Sam. So on the previous slide, we established things that can impact energy market prices and briefly discussed some of the tools available to track and follow those drivers. So on this slide, it shows how CCS views the market and how we interact with it. So we access electricity and gas markets via our framework suppliers. This is a fairly standard approach for public buying organisations or brokers. So at CCS, we, the trading team, have a relationship with the suppliers' optimization desks or even traders themselves. And when we want to place bids, we call suppliers, tell them specifics of the bid that we'd like to make. So for example, we'd like to buy maybe 10 megawatts of Winter 22 baseload electricity at a price of £215.50 a megawatt hour. The supplier will then work that bid, and that could be done in any number of ways. So they could place the bid on screen, an example of which is shown on the right hand side of the slide, or they could, for example, sell from their own generation books. So if you think EDF is an example here, they have a massive nuclear fleet, so they could sell to us from their own generation. At this point, if a trade occurs, CCS or the customers don't take title to the energy purchased. It is the supplier who acts as the counterparty. And then following on from that, the tripartite agreements. So you'll know those as the framework agreement, the model contract, or the customer access agreement, or the CAA, provide the processes around how these costs are subsequently recovered by the supplier through invoices. So electricity and gas prices, like other commodities, change on a minute by minute or a second by second basis. And so it's vitally important to see real time what's going on. At CCS, we have full visibility onto the market on an instantaneous and on a real-time basis. So we use a piece of software called Tradeport Joule, which again you can see on the right-hand side there, a little bit of a snapshot of what Joule looks like, as well as Bloomberg and Reuters to provide visibility. So for example, if a gas pipeline bringing gas from Norway was to have a leak, first of all, we'd see the change in gas flows as they were coming into the UK. But we'd also instantaneously see as the prices responded on Joule, such that we could interact in a timely manner. So the CCS electricity and gas portfolio is pretty significant size-wise. As a collective group of customers, there's no other customer-based portfolio in the UK anywhere close to the size of a portfolio that we buy for. And there are benefits of being such a significant size, including being able to offer different risk products or baskets, as you might know them, as we call them, and allowing us to make multiple timing to market decisions when we're hedging customer demand, rather than being forced to do this on a single day. We're therefore spreading the risk and making more effective overall risk management decisions. Next slide, please, Sam. So now we're going to move on to what's been happening to energy prices in recent months. So on this slide, you can see that I've created a table on the left-hand side, which shows absolute price change since the last call that I presented on at the end of September 2021. This table not only shows gas and electricity price changes, but also currency, coal, oil and carbon, which are important drivers. And on the right-hand side, there's a couple of charts which show how prices have changed over the past 7 months or so. So as you can see from the two charts showing the seasonal gas contracts at the top right and electricity baseload contracts on the bottom right, it's been a completely unprecedented and somewhat unbelievable time in energy markets. So at the end of since the call at the end of September 2021, prices have been on quite an incredible journey, incredible volatility, and reaching ever more and new sort of terrifying heights. So within those charts and the table, I've selected a few key contracts to illustrate what's been going on, rather than sort of overwhelm you with lines, charts and data. And what we and the rest of the market thought was pretty dramatic in September, got even more extreme towards Christmas, and then once again as Russia invaded Ukraine. I'll go into a lot more detail on this in the following slides, but as you can see, since September 2021, we've seen some gas and electricity contracts on the wholesale market more than double. Just a bit of a reference, I think we've mentioned this in previous communications. Relative history would show that electricity prices, we've become accustomed to seeing electricity trade around sort of 30 to 60 pounds a megawatt hour, but for electricity it's going to be delivered in this coming winter 22, it's currently trading at 230 pounds a megawatt hour. So a pretty significant jump up in that time from what we've become accustomed to. And what you can see in the chart on the right, you can see that winter 22 baseload is traded in excess of £300 a megawatt hour, not too recently. And then even on the gas side as well, summer 22 gas traded in early March as the invasion first happened, traded up to 500 pence per therm, £5 a therm, which is absolutely incredible. So if we go on to the next slide, please, Sam. So I want to set the scene first. So on this slide and on the following slide, I'm going to discuss what's happened over the past 6 months or so and what's been driving the market. This slide, as I said, sets the tone, sets the context as what's happened over the course of winter. And the next slide, we're going to look specifically regarding the situation in Ukraine and with Russia. So before we got into winter, Europe had witnessed low renewable generation, in particular very low wind speeds through September, which had put additional pressures on gas-fired generation to meet the power demand. As we came into the start of winter 2021, we saw prices at the time. We thought, and the rest of the market thought, were high and volatile. But as you've seen from the previous slide, what the market was showing back in October or September time is actually nothing compared to what we've seen in around Christmas time and into the start of this year. As we went into winter, there was historically much less gas in storage across the whole of Europe that we've ever witnessed, and a view that if Europe witnessed even a slightly moderately chilly winter, there'd be significant trouble. All that was against the backdrop of the world emerging from COVID, which has been causing demand to increase across pretty much every single commodity. Linked to this, we've seen a big competition for liquefied natural gas, or LNG, between Europe and Asia. The LNG market has become increasingly tight over the last few years, with significant demand coming from Asia and not much, if any, spare capacity for additional supply. Carbon prices were at historic highs, although in hindsight they had a much more of a journey to go on. And finally, we were seeing lower than usual Russian gas flows to Europe. The much discussed Nord Stream 2 pipeline was facing delays due to sanctions, mainly from the States, making it nigh impossible for Russia to complete the build of the pipeline quickly. There was even thoughts at the time that it might never get completed. As we went through the winter, there was a series of events that caused prices to rise even further and the volatility to go off the charts. There was one saving grace. Europe, and I think in fact quite globally, winter wasn't that cold. It was quite mild. Europe in particular saw very few cold days. I think, like I said before, if Europe had had a significant cold or even continued moderately cold weather, there'd have been a big increase in gas demand and a much quicker drawdown in storage. Even as it was, with a pretty mild winter, gas storage stocks fell to exceptionally low levels by the end of March, and this was despite continued promises from Gazprom and Russia that they would increase flows to Europe, but the gas never materialized. The additional gas never materialized. Gazprom used to own and operate for storage facilities in Europe, in Germany and Austria in particular. And again, they made promises to inject gas to increase the storage level there, and that never arrived either. These facilities, just by way of context, this is the one you might have seen in the press, Gazprom Germania, which the German regulator has subsequently taken on. We saw carbon rally from the highs at the time of €65 a tonne at the end of September. And in the past 6 months, as I said, it's been quite a journey. We've breached nearly €100 a tonne at the start of February. And then as Russia invaded Ukraine, we saw the price collapse from around €95 a tonne to around €55 a tonne. And just today, I was just having a look, we're currently about 81, 82 euros a tonne for carbon. So quite the journey. To continue to the theme seen in the summer, we've continued to see, or we saw inconsistent renewable generation across Europe through winter, which added further pressure to gas grids. To further compound electricity grid issues, there were significant issues with the French nuclear reactors, whereby they found issues with welding and units were shut down for safety reasons. France is normally an exporter of electricity to its neighbours, but in this situation, there was further strain put on everyone else around to help France meet its needs. And then even further to compound market driver related issues just discussed, we've seen liquidity, or sometimes you call it activity, in the market has really dried up. One of the reasons could be due to credit, counterparty credit, as well as volatility putting stress on traders' positions and forcing them to close them out and focus on smaller or even closer in positions. So the impact on buyers like CCS is that it makes it much harder to secure volume in the market. And this is even before Russia invaded Ukraine. So next slide, please, Sam. So given the context we've just been discussing, we need to now layer in the situation in Ukraine. It's introduced a whole new element of complexity and uncertainty into commodity markets, again, as never seen before. There's a lot of fear around what could happen, and the possible outcomes are wide and varied. So hopefully I've done this slide in sort of chronological order. In early 2022, Russia had been amassing troops along the border with Ukraine as far as Belarus and all the way to the south in the Black Sea and Crimea. However, at no point at this stage did energy market participants think that Russia would take the path it subsequently has. And then on the 24th of February 2022, Russia invaded Ukraine, prices immediately spiked. And in the following days, the situation started to develop. Prices originally dipped from that level, but then rose even further. And following the invasion, there was obviously widespread condemnation of Russia's actions, and countries even started to impose sanctions on individuals and organizations. From a commodities market perspective, the fear here at this point was that sanctions on banking and finance would impact the ability for countries to pay for those commodities that they were taking. And as the atrocities in Ukraine were revealed, organizations started to self-sanction, i.e. taking decisions themselves to stop buying commodities, with the biggest impact felt in Europe around coal and oil in particular. Alongside the more formal sanctions, the impact of self-sanctioning has really disrupted global balance of commodity flow, which, to be honest, is really yet to shake itself out. And although many countries have stopped taking Russian commodities or promised to do so imminently, some countries such as India and South Korea have actually continued to take coal and oil, and in India's case, probably in increasing amounts. You'd have seen it probably on the BBC News. I think it was yesterday. I think I saw something. Meanwhile, Europe has been scrabbling around to secure coal from countries other than Russia, which has really pushed coal prices up. Gas flows or trade in gas is so far yet to be impacted by sanctioning or self-sanctioning. Nord Stream 2, again, quite a widely discussed topic of conversation. It's the second gas pipeline coming from Russia into Germany via the Baltic Sea. It's been a good few years in the making in the construction. It did actually face significant challenges and hurdles along the way of the construction. However, following the invasion, German regulators cancelled the certification process, effectively ending any chances of the pipeline becoming operational. This pipeline was meant to bring additional gas into Europe, due to start later this year, but now existing pipelines coming from Russia into Europe are having to be optimised, limiting any additional gas that could come to Europe and thereby potentially alleviating any potential future supply issues. Over the past 6 weeks, there's been multiple rounds of peace talks, haven't really yielded anything. There was some positive sentiment in the first round, which initially caused prices to fall, but things have settled. But once things have settled, there was no real progress made. Prices continue to move up. The most game-changing thing that's happened over the last 6 weeks, that will not change the situation ever, the response, the EU response to reduce their dependence on Russian commodities as part of the Repower EU model. So within this model, they're looking to implement things such as increase renewable energy generation with less reliance on thermal generation fueled by Russian coal and gas. And even if there's a managed agreement for Russia to stop its invasion of Ukraine, the Repower EU plan won't change. The EU will continue its journey away from Russia. And if we look historically, Russian gas has been plentiful, relatively cheap. So moving away will be a significant challenge and costly. Although something we've not seen so far, there are fears that there could be damage to infrastructure, which would impact the flows of Russian gas to Europe before Europe has weaned itself off, and therefore be in a position to manage without Russian gas. This fear also extends to the potential for Russia to turn off the taps, although Russia has a huge dependency on the money raised from gas sales to Europe, Germany in particular. And finally, probably one of the most recent things occurring in the news just over the last couple of days is Gazprom's demand for payment for gas in rubles. This is seen as an illegal change in contract by Gazprom, and all European buyers apart from Hungary, which is quite Russian leaning. I think some of the government in Russia has rejected the change to pay in rubles. In the last couple of days, you'll have seen that Gazprom has actually cut supplies to Bulgaria and Poland for refusing to pay for gas in rubles. Prices have moved up accordingly, and the fear this would roll out to other countries. However, it does look like Gazprom has picked on the low-hanging fruit within Europe. Both these countries have been quite small takers of Russian gas, and actually Poland suggesting that they were going to let their contract with Gazprom lapse anyway at the end of this year. It's a very complex situation. There's very complex workarounds that the European governments have been looking to explore to continue Russian flows of gas, and this one will keep rolling on, I think, in the coming days and weeks. So as we go forwards, there's one thing the market has learned, which is that Russia or Vladimir Putin is highly unpredictable. There's any number of potential outcomes, and as you can see from the slide, I've tried to outline a couple of them. So Russian gas flows continue to plod along, as we've seen, which would be a relative comfort to the market as Europe starts to move away from Russian gas. So in this scenario, prices might move down slightly from the current level, albeit remain exceptionally elevated. And then under what is seen as probably the worst case scenario for commodity flows, gas flows could be stopped, could be due to damaged infrastructure or Gazprom turning off the taps. Prices would likely move upwards as Europe struggled to cope. We'd see demand destruction, and we may start to see the most expensive form of power generation start to generate, which would be oil-fired generation. And I think what it's fairly safe to say is that we're highly unlikely to see prices return anytime soon to levels we've seen and become accustomed to in recent years. Next slide, please, Sam. So on this slide, trying to explain a bit about the changes in the commodity prices over the years that we've achieved for the baskets. And the charts are pulling the same data as that is used in the monthly market reports, the purchase reports that we send out. But these are for energy or commodity only. The same charts that we showed in September, but with updated figures, and they include the latest L24 and L12 baskets that we've started trading for in the last few weeks. So you'll notice that there's a variance in the impact the current markets are having on baskets. This is because of the risk appetite that you, the customers, have, or your ability to contract to a different length to CCS. So we're going to look at a bit more in detail of each particular basket in each particular year. So as you can see, prices achieved for gas and electricity baskets from 2018 through to 2021 And to be fair, if we'd extended this chart backwards even further before 2018, you'd find that things were pretty flat and fairly similar from basket to basket, especially when compared to the situation from 2022 onwards. So as you can see from the chart, or from the two charts, for the April 22 delivery period, there's a wide range of outturn prices across the baskets that we've been buying for, which occurs mainly because of the timing when we had the ability to hedge the volume. So for example, for the V30 baskets, we've been hedging that volume for those customers since October 2019, which is obviously long before the situation in Ukraine escalated. Similarly with the L12 basket, we began hedging volume from April 2021, and the majority of that volume was actually purchased early in the purchase window. From the L6 and the V6 baskets, we were only able to start hedging that volume on the 1st of October, when, as we saw, prices had already started to escalate. Consequently, stop loss limits took effect, and we were forced to purchase the majority of the volume. But as I said, these were already at prices that were already elevated in an elevated market. So if we look ahead at the baskets that are open to be hedged for 2023, for the V30s, we've been hedging the volume since October 2020. And so we've been able to partially protect this basket from the full extent of the escalation in prices that we're now seeing. The 23 V30 baskets are currently 70% hedged, which is in line with risk policy. And the 23 L12 baskets opened just 3 or 4 weeks ago. And given the escalation in prices recently seen, our risk metrics have bitten, and we've actually secured a decent amount of volume. And if we look even further ahead at the April 24 baskets, we've been hedging the V30s from October 2021. And again, we've secured a decent amount of volume there in what is a highly liquid market. The L24 basket opened again just 3 or 4 weeks ago. Stop loss metrics have taken effect again. And so we've secured some volume to go some way to protecting customers from a further price escalation. I'm going to now hand you back to Kate, and how she's going to look at how changes in these commodity prices as well as non-energy costs may affect budgets.
Thanks, Tom. So on the previous slide, Tom discussed the impact the rise in wholesale prices had on the commodity aspect of the baskets. So on this slide, I'm going to layer in the current forecast of the non-energy costs and try and bring some of the expected increases to life. So this data is similar to the tables you see in the monthly market reports, which hopefully you are familiar with. So across all the baskets, the element of the cost being attributed to non-energy elements has increased year on year. April 21 saw increases in the cost, and it rose again in April 22. What was also seen in the 22 non-energy costs is the introduction of costs that were attributed to the supply of failure activity. So uninterrupted gas costs and the supply of last resort impacts has been shared across the network and inflated costs even further. So the table shows the full basket differences, and it's a lot of figures, I appreciate that, and ones you don't always see, as we generally send you reports that are showing the baskets that you're a member of. The key points is a note to notice that the protection that the longer term strategies are giving are seeing in the variance in the forward estimates, though there is also adjustments that are already being seen in these basket forecasts. Tom has given a lot of information regarding the trading activities, and one point he did cover is liquidity. So our strategies are implemented, though can be impacted by poor liquidity, which means if the basket needs to purchase volume because of a breach of our stop loss limits, it's only possible where there is volume being sold in the market, or we were able to use the limited indexation options within the framework. This can cause the price we achieve to end up being higher than the stop loss limit, and therefore elevate the budget forecast we have calculated. All of the non-energy costs are subject to change as rates are firmed up as we get closer to the delivery year by Ofgem, BEIS, etc. And the further out we go, the more uncertain the forecasts become. It is worth noting that there are costs within the prices that are set and then reconciled after the delivery year as the system balances the costs to run the grid and the actual costs become fully known. So one such cost is the BSUOS cost, and this is the cost to balance the system. And it's likely with demand and generation challenged as much as they have been this last year, these charges will be elevated and recouped at some point. Next slide, please, Sam. So as well as hosting webinars such as this, we share frequent information to our customers regarding progress on the purchasing, impact on forecasts, and have also developed in the last year site level forecasting. And all of this should be used to monitor the impact market changes have on your budgets and brief to your colleagues as necessary. The document in the centre is our performance review that we carry out each year to assess how well we've done against the market average. And this is a review that underpins our values of transparency and is an honest assessment of what we did and also what we could have done differently. And it's an important tool as it demonstrates that we are continually assessing the strategies that we employ for all our customers and adapting our tactics accordingly. Generally, this document is published in the summer, early autumn, so keep an eye out for it later in the year. And the budget forecast that you can receive to show your site level expected changes will be highlighted in the May newsletter, which is demonstrated on the top right there. Please have a look at the options you have available and complete the form to take the opportunity to understand the impacts across your estate. Next slide, please, Sam. So as we've shared extensively today, energy prices are high and they don't seem to be changing fast. So what can you do to mitigate the impacts that we're seeing? The next few slides I'll cover will talk about the different options that are there for you to consider. So your strategy. In an earlier slide, Tom showed the different prices that each basket has achieved or is currently forecasting to achieve. And the overarching trend is that the shorter term baskets are more susceptible to market fluctuations, and then therefore your budget management can see much more extreme swings in spend from year to year. As demonstrated the previous years to this, the differences that we saw across the baskets wasn't that extreme, and the shorter term strategies were just appropriate for different customers that have different commitment levels. But in the energy team, we are actively supporting the move now from V30 and L6 and V6 baskets to longer term strategies. This slide shows the different options that there are, and the transition to these will have different timescales as you can only be emptied into a basket prior to it starting trading, but we can support your journey to incrementally increase your buying window. We also have the option of opening a new basket if we have enough volume to do so, and we continually assess the strategies we have available and the frameworks we have in place enable that agility to deliver the best value. Next slide, please, Sam. So the current market conditions are expected to continue and trading strategies will continue to be reviewed. As covered earlier, there are a lot of uncertainties and unknowns in relation to wholesale market conditions. However, we are doing everything we can to secure you the best possible prices. A key element of mitigating the cost is to reduce consumption where possible. Understanding when and where your power and gas is being used can give you the right information to make changes that will have the biggest impact on budgets. Information can be found on suppliers' websites, and you can also look at options to contract with suppliers through a variety of CCS solutions to give advice, implement building changes and install new solutions to deliver efficiencies. One issue we hear frequently is access to finance to be able to implement estate changes that will support energy management and also, or maybe even primarily support net zero targets your organisation may have. A route we have available is in CCS is the Leasing Advisory Services Framework and the Asset Finance Agreement. These solutions give a route for understanding what options you have and gaining finance to support the delivery of an estate strategy that can take you further in managing energy and emissions. If anyone needs information on this, please contact our service centre through the info@ email address and they'll direct you to the right people because those contracts don't sit within the energy team. Next slide, please, Sam. Whilst the energy market elevation is likely to be here for the foreseeable future, we're moving on with maximising value of all the commercial solutions we have in place and that you use to provide your services for the public. The trading strategies is the most obvious element, and as Tom has shown, the team are working hard to take the best steps possible to navigate us through these challenging times. As shared today, a key action that we're ensuring is supporting through supplier guidance and routes to market for finance is how best to manage consumption. Contracting for longer term agreements with generators is something that we're working towards currently. And I know I haven't shared this in depth today, but more information on how you can get involved in scoping the requirements will be shared through our newsletters. We're currently conducting user research into the information requirements of our customers and CCS, and an early output of this has highlighted the desire from our customers for access to a bureau type service. We have several ideas how this might be delivered, and options are being developed. An engagement with our customers to ensure the solution delivers requirements will be taking place in the coming months. And if you'd like to participate, please email info@ and we can include you in future notifications. And our major task for this year is to relet the supply of energy agreement. And many thanks to all that have already been involved in work to identify the requirements of the next iteration of this agreement. Work will continue in the summer to refine and develop the terms of the agreement prior to the tender in the autumn. So now we've finished our update and we can go to our questions and see what we can answer during our time today. And if there are any questions we don't get to, we'll cover in our Q&A document that we'll share with all our registered guests.
Cool, okay, thank you, Kate. I think we had a couple of questions that had been pre-submitted, so I'll just stop sharing now. So we'll share our contact information at the end again also. So I'll just stop sharing screen, so you should be able to see Tom, Kate and I now. And we had some questions pre-submitted. The first of those was, let me see. Are we observing any positive trends in the energy market? So I think we can go to Tom for that one.
Yeah, thanks, Sam. I was very wary when I was coming to the end of when I was speaking that I was sounding more and more negative, and actually probably my tone of my voice as well was probably coming across as quite downbeat. So this is probably a good question to pick up on. Like I said, although what I was discussing was all quite negative for prices, I think in the longer term, the model of pursuing a greater level of renewable generation in terms of that Repower EU model should, in the longer term, help to reduce costs overall, as well as making the the UK, less reliant on other countries as well. The other aspect to this is obviously from a decarbonisation perspective. Although gas-fired generation is cleaner than coal, obviously solar and wind and hydro is zero emissions. Also, we've seen LNG market respond, the liquefied natural gas market respond in the shorter term by bringing additional gas to Europe, currently away from Asia. But I think in the longer term as well, LNG projects are using the current pricing that we're seeing to help build business cases to bring additional LNG to market in the coming years. Now, those projects aren't going to happen overnight. A typical LNG export facility could take somewhere like 5 years to construct. And there are challenges even with that. Price of steel, for example, have risen as well. I suppose building on current developments, the need to accelerate away from Russia quickly, it will drive the development of sort of slightly more new technologies, such as things like hydrogen and batteries at a much quicker pace as well. And finally, I think one of the important things to say is that energy is really at the forefront of discussions in everyone's minds at the minute. So I think things like energy efficiency, if I can say energy efficiency, and consumption as well are going to be really sort of a key focus going forwards.
Cool, thank you, Tom. So our next question then, can you explain in more detail the impact that the price of coal has on the energy markets?
Yeah, so although I think if it had come back maybe a few years, coal prices were very cheap. Coal was widely seen as sort of a market that was sort of coming to its end, especially in the world of decarbonisation. But coal is very important even still, because maybe not so much in the UK, but across Europe, in particular in Germany, they use a lot of coal and a product which is a type of coal called lignite to power their or to generate electricity in significant amounts. So if coal as an input fuel to generate electricity has obviously become very important, and then it links in to kind of setting the tone or setting the price for power generation. So yeah, you'd think it wouldn't have much of an impact, but it's all to do with generating electricity. And the thing with coal is as well, it's such a global market that what we're seeing, or what we have been seeing recently, is that coal prices have been even more driven by what's going on in Asia. So although I think Germany only makes up about 2% of coal market globally, Asia and China in particular, I think it's about 50% on its own. So what happens in China in relation to coal will kind of set the tone for coal markets across the world. And China's been buying up coal in significant amounts over sort of winter and even before winter. So yeah, it's a very global market. But yeah, in relation to the question, like I said, it's to do with generation.
Cool, thank you, Tom. So we've had a question around the April 22 pricing schedules and when they can be expected. So for electricity, all of the pricing schedules have been released by EDF now. So that is for all of the locked and variable strategies. For gas, for the locked 6 strategy, we are expecting those prices to go this week before the end of day on Friday, hopefully. And then for customers in the gas variable baskets, you'll receive this in your monthly price change reports. So when you receive your price change report at the start of May, that will have your confirmed rate for the April month, and then it will have the forecast for the rest of the year. And as normal, as we move through the year, that monthly price change report will firm up what the costs are. So next question then is, are there any risks of low gas storage levels entering next winter across Europe?
Yeah, so I'll take that one. I think the answer is yes. But one of the things that is happening across Europe at the minute is that they're trying to create a position where we don't have that situation. And what they're trying to do, or what they're thinking they're going to do, is to have minimum amounts of gas in storage forced, basically. Force the storage operators and participants to inject gas into storage. So I think, again, like I said, my focus is on the electricity side, and more so on the electricity side, but I think their target they're looking for is to be 90% full by the start of November this coming year. And it's something that, again, I wasn't aware of this until quite recently, that France has already had in place. They've had minimum gas injection requirements for quite a while, and well, like I said, there's different ways and means they can do it. They're still, I think, exploring how this could happen, but certainly it looks like that Europe doesn't want to go into a position for next winter with not a lot of gas in storage, as you could understand, with Russia being such a significant provider of gas, and if that wasn't there, that we would have to fall back on gas in storage. The UK itself, I think it's important to mention here, there's different types of gas storage, and there's gas storage that you can inject into and withdraw from very, very quickly. You can fast cycle, and there's other storage facilities which are massive old gas fields, and it takes a lot longer to inject, it takes a lot longer to withdraw. The UK, since they closed Rough storage a few years ago, has no long-term gas storage facility. So that means that we have a link or a connection back to Europe, and we Europe and the UK effectively become one again. We would be reliant on them. It's not as if the UK would be all right on its own, and we would be very much linked to what was going on in Europe. So, like I said, the answer is yes, there are risks of low gas going into the winter, but Europe is doing everything it can to minimise that risk.
Well, thanks, Tom. And then we'll just take one more question. So we have had quite a few questions submitted, and we will answer them all in written format after the webinar. So don't worry if your question's not been answered today. There will be an answer provided when we send the recording and the slides out. So the last question I'll take then is, in our newsletters, we mentioned having pre-purchased gas and electricity that wasn't used. When we sell back to the market, do we use this to subsidise the unit price or to purchase more for future supplies?
Sorry, is that one for me, Sam?
Either, yeah, or if you or Kate know the answer.
Sorry, can you just say it again? Sorry, I wasn't, unless Kate was.
Sure, I'll cover it. So when we have pre-purchased gas and electricity, there's two different elements to it because the contract takes different forms. In gas, we carry all the volume risk. So that means that if we have purchased more gas than we need, then we will sell the excess, and then then whatever, if it's sold at a profit or it's sold at a loss, the basket will bear the impact that has. So that's why we actually have a strategy to purchase gas to 90% levels. It fluctuates depending on what's going on. So for example, over the last few years, we've moved baskets from Corona to Total, and we've had to transition meters. Some have made it on time, some haven't, for different reasons. So we have to adjust the volumes accordingly. But the gas basket does have that. And so in recent times, yes, we have benefited from the markets rising whilst the basket has been purchasing, and then we've been able to sell, and we've given that profit back to the basket. And everybody has benefited, but the opposite is true, and that's why we don't speculate. We're not able to. That's not within the realms of what we can do in line with Treasury. The electricity carries a different contractual position. So at what's called M-3, which is 3 months prior to the delivery window opening. So I'll use April 22 as an example. So for the April 22 basket, so L6. In January, we went into what's called our final shape position. So we finalised everything in regards to the volume requirements for that basket. At that point, the risk transfers over to EDF, and then any sell that needs to take place if we've overhedged is borne by EDF. So therefore, any additional costs that are occurred, so i.e. they have to sell at a loss, or the alternative is true as well. And that's why it's really critical that we get our volumes correct, because one, we don't speculate because of we're government, but also we're not here to, in some respects, give additional money to somebody like to EDF. So it's done in different ways, but at any time, if there is an opportunity like a sell that has benefited, it'll go back to the basket and it will be shared through the reconciliation that occurs for that basket.
Cool, thank you, Kate. Okay, so we'll leave it at that then, so we keep the time for today. Thank you everyone for joining, and we hope you found the webinar useful. For reference, if you need to get in touch with us, our email address is info@crowncommercial.gov.uk. And if you've got any questions about anything that's been shared in the webinar today, if you want to send those emails for the attention of the energy specialist team, someone from my team will contact you in the next week or so, and we can potentially look at arranging a call to answer those questions for you. So, yep, thanks everyone, and we will hopefully see you again on future webinars. Thank you.
Bye.